Good morning. Thanks for attending. I know it's 4th of July holiday, so I really appreciate your attention. Interesting markets here. We're going to go over a lot of stuff today. This is a monthly event, and it's part of your individual investor research subscription. This is our way of being able to connect with everybody kind of one-on-one. Everybody can see my face, see my office, and hopefully we're going to do a couple of things. We're going to show you how to use the models, how to understand the models, how to interpret them, and then how to put them into your portfolio, how to integrate them into your portfolio. Questions, comments, and interaction are most welcome. Audrey is going to monitor the questions coming in and interject them into the presentation when she thinks it's appropriate. And whenever I think of it after I finish a subsection, I will ask if there's any questions. I want to have you leave this venue today having a better understanding of what we do, and again, how to use the signals in your own investing. Special welcome to those guest participants in today's teach-in who have recently requested information about us, either as a potential research subscriber or as a Asbury Research money management client. This is a one-time special opportunity if you're a guest here to learn more about us before making the decision to become either a subscriber or one of our clients. Again, the purpose of these, number one, to make sure you understand how to use the data-driven models and research and implement them into your own portfolio. And number two, to go over some of our most recent research and also look at some live charts to provide you with some additional color on what we think are the most important things to pay attention right now. Jim Bettendorf, getting a little bit of feedback on your side, so if you can mute yourself, that would be great. Thank you, sir. So I know for some of you that have been with me for a long time, going through the models is going to kind of be old hat for you, but this is also for newer people coming in, so please be patient. I've got a lot of charts at the end that are live charts showing you what I'm paying the most attention to. Jack and I are paying the most attention to here, and I think it will be worth your while to sit through the stuff you already know, so I can get into some of these charts that I think you'll be interested in. Finally, if you need some additional help, you can also schedule a 30-minute Zoom meeting with us via the link at the top of the Research Center, which you should be able to see. So we're going to go to the Research Center right now. You should see Follow the Money with Asbury Research on your screen. And if we scroll down, you'll see schedule a Zoom meeting or phone call with us by clicking here, and you can see it's hyperlinked, that it lights up. So again, if you're confused about anything, set up some time with us. Jack and I will spend some time with you. These are great tools. These are the result of me doing this for over 40 years, spending almost 20 years on the trading floor of the CME in Chicago in the 80s and 90s. And there are tools, right? So we're not going to talk a lot of MACDs and stochastics here. You can get that anywhere. These are primarily our tools that we use to find out what's going on underneath the hood of the market and not just tell you the market is overbought, which you don't need me for. So it looks like Steve Hodge, you're having some problems with your volume. If everyone else can hear me, can we get a show of hands? Maybe you can help me with that, Audrey.
Yep. Everyone else is raising their hand.
Okay, great.
So Steve, I'll send you a message in chat.
Thanks, Audrey. Okay, so let's begin by just kind of looking at economic broad overview themes of kind of what's been in the focus of the market lately. Over this past week, we had the minutes of the Fed's June FOMC meeting released the day before the 4th of July on 7/3. It indicated that inflation is cooling, but not fast enough for the Fed to lower rates. Minutes also showed that policymakers lacked the confidence they needed to lower rates. And they generally agreed, though, that there was no real urgency to cut. So relatively benign. The market really didn't react to it. June jobs report came out on Friday after the holiday. Overall, economists said that the labor market is still strong, and though it's starting to slow down, it is returning to normal after a white-hot pace over the past few years. Traders were optimistic Friday about the slight uptick in the unemployment rate, which could indicate that the Federal Reserve may lower rates later this year. All of that stuff is really up in the air. And frankly, I've never made it a signal trading decision in my life based on what I thought the Fed was going to do. To me, that's three-dimensional chess. It's something we can't know. What I would rather do is once these report comes out, I want to look at our tools and look at our models. I want to see what volatility is doing. I want to see what market breadth looks like, where the money is going. Those are much more important to me, important to us here at Asbury, and much more influential, I think, in trying to stay on the right side of the market. We're all this other stuff is speculation of what we think is going to happen, and the market could care less what we think. We just follow the money here. Technical and quantitative broad overview. With the exception of about 2 weeks in April, CPM has been on a risk-on status since November the 3rd. CPM is a correction protection model, while SPX, the S&P 500, has risen by 29%. On the Research Center for subscribers, correction protection model is right here. And you could see risk on as of May 3rd. And you can see we initially went to risk on actually on November 2nd. After the close, it was executable on November 3rd. We were out of the market just for about 2.5, 3 weeks here between April and May, and re-engaged. Sector rotation, according to our CEF model. Our CEF model is, Tim, I see your hand. I'll get to it after the end of the section. Our CEF model right here, by the way, freshly updated. CEF stands for Sector ETF Asset Flows. The sector rotation, according to CEF, remains erratic since really the second week of January, which is when the AI stampede higher started. We had a breakout in NVIDIA right around January 8th, 9th. That's when there was a big symposium. There was an AI/tech symposium, I guess you'd call it, in Las Vegas. NVIDIA and other companies made some AI-related news. And that's really when this year began, when there's a handful of mega cap AI-related tech stocks that have basically dragged the rest of the market higher. So sector rotation is still erratic. What does that mean? And we'll look at CEF a little closer, but we don't have the market really going into one sector or two sectors and staying there. It's been constantly rotating. I think that indicates uncertainty in the market because the market's come so far so fast. It's very thin in order, in the sense that just a few huge cap stocks are dragging the rest of the market higher. So atypical, but it does happen. The market typically goes from periods of uncertainty in sector rotation to periods of certainty. Right now, we're in an uncertain period. Non-US equities. I hear on TV, everyone's talking about, where to go outside of the US. Right now, there is nowhere to go according to our data-driven model, which is US versus the world here, which we'll take a little closer look at. The only outperformance of late is from Taiwan. Ticker EWT is the ETF. Due to the island's situation where it's a key player in the AI revolution, in the manufacturing and development of AI tools. Finally, metals are again threatening a major bullish breakout. I've been talking about metals on and off since the beginning of the year. We've been in and out of gold miners a couple of times already. The first time I think we made 7 or 8%. and we took a profit and got out because it started to reverse. The second time, I think we were basically a scratch. We tried to buy a breakout that didn't hold. Metals are starting to threaten again. I'll look at some of those charts with you when we get to that part of the presentation when we're looking at live charts. I'm going to pause for a question or two as we kind of shift gears and start going into another part of the presentation. Is there any? Are there any?
We're good to move forward.
Okay, great. There was one I saw. I must have retracted. Hopefully that's because I answered it. So we're walking through the models right now. The Asbury 6, that is our daily under the hood indication of what the internal condition of the market is. We look at 6 things, and they're all marked to a 21-day basis, which is a business month. So we've got the rate of change in the S&P 500, relative performance of stocks versus high yield bonds. When stocks are outperforming bonds, the market is generally healthy. When they're underperforming these bonds, it's unhealthy. Investor asset flows in SPY, which is the ETF, of course, that tracks the S&P 500. Excuse me, volatility via the VIX, trading volume, and market breadth. The reason that we do this, and this is updated every day about an hour or two after the close in the research center, which we're in right now, the reason we do this is because the market's changed drastically, in my view, over the past 10 years. There's a lot more daily or intraday noise that you see in the market. Just a couple of days ago, the S&P was up 50 points mid-morning, and it was down 50 by early afternoon. And I think it closed somewhere in the middle. So it's very easy to get Michael, I saw your question, and we're going to look at those with charts at the end. If I don't give you what you want at the end, make sure you ask me, and I'll get more specific. It's meant to be an indicator rather than a model. It's a daily indication of the broad market's internal strength. It's been positive since June the 25th, as you can see, but it's been blinking since early June. What does blinking mean? Blinking is when these indicators start, rather than getting green and staying green, they start blinking back and forth. They might be 3 green and 3 red, which is 3 positive, 3 negative. They could go to 4 to 2 and then 2 to 4. And there's a lot of kind of erratic jumping back and forth. That normally happens when the market is in balance, and it indicates indecision. We're starting to come out of that a touch now, but you can see the blinking here. You can see all this blinking here really since the beginning of June. What does that mean? It means that the market is uncertain. The CPM is built to get you in the market at great levels and keep you there as long as possible. This is built kind of like an EKG for the market. We want to see every little twitch so we understand what's going on under the hood of the market. Because if all you do is stare at the S&P 500, I don't know how you make any money. It's so easy to be shaken out of a good position because the market was up 50 in the morning and down 50 at night. The A6 is going to give you a daily data-driven indication of what the real health of the market is. CPM, as we go back to the research center, CPM is the correction protection model, CPM. The last change in the metric was it went back to risk on as of May the 3rd. Here's that chart. So you can see quite a bit of choppiness in between August and October of last year. But once we went back to risk on November the 2nd, we caught this huge move up into the April highs. We sidestepped for a couple of weeks or so, going into May as the internals started to deteriorate, and we've been risk on since. So again, risk on since 5.3, SPX is up 8.6% since then. We're going to show a graphic. Here's some details through June. CPM up 14.4% year to date versus 16.1 for the S&P 500. But also year to date, CPM's maximum drawdown is only 3.6% versus 5.5 for the S&P. This is what it's supposed to do, give you the market with less risk. It's about 40% less risk if you're looking at the maximum drawdown. Also, lower standard deviation, lower beta, better Sharpe ratio, and if you don't know what Sharpe ratio is or beta, my suggestion is to go to Investopedia.com, look these terms up, ask us, we can direct you. But these are, when we build models here, we're not looking for some pie in the sky great year where the model made 40%. What we're looking at is keeping those risk-adjusted numbers down. A good Sharpe ratio, a better than 1, means that risk versus reward is very good. A low beta means there's less risk, there's less volatility. Same with standard deviation. There's less noise in terms of your return. Since October of 2017, CPMs, even with SPX, going all the way back then, but with the 20% maximum drawdown instead of 34% for the S&P, standard deviation in CPM going back to October of 2017, 12.3 versus 17.3. So you're getting the same return with less risk. For you older, more risk-averse investors, this is what I want. I'm an older investor, and although I take risks when I think are appropriate, I want to sleep at night too, and I think the CPM really helps towards that end. The other thing that I wanted to show you, I'm going to switch views here. So let's do a new share, and I've prepared some charts for you today, a bunch of charts actually. So just let me move a couple things around on my screen so I can see. So this is CPM versus SPY. Just going to take a quick look at this because I want you to understand. Let's see if I can make this bigger. I can't. I hope this is big enough. Oh, how about that? I just figured it out. Okay. So here's year to date. I talked about SPY versus CPM. This is historic, going back to September of 2017. You see the annualized total return of SPY, which is here, and CPM nearly identical. But look, here's the maximum drawdown. Only 20.2% for CPM versus 33.9% for SPY. Risk, according to standard deviation, 12.3% versus 17.3% for SPY or the S&P 500. Again, a beta of 0.6 instead of 1. The reason I'm taking the time to show you this is not to take a victory lap, but rather to show you what this tool is for. This tool is to teach you how to use the model, how to understand what the model does. Something else we're going to look at real quick here as I change views again is, let me see if I can just move a couple things around on my screen so I can see better what I'm showing you. I trade CPM with some leverage. I have customers that say, hey, John, I'm willing to take more risk. Here's how we recommend that you do it. Here's how I do it for my own account. So this is CPM here with SSO. So you've got since 9/28 of 2017, this is trading CPM with 65% SPY and 35% SSO. SSO is the 2 times leveraged S&P 500. So what we're showing here is annualized total return 12.4% again since fourth quarter of 2017 versus 15.6, trading CPM 65% of that. Let's say on a $100,000 hypothetical account, 65,000 trading SPY, 35 trading SSO. These are back-tested results. I can't see into the future any more than anybody else can, but for those that are looking for a little bit more market exposure, willing to take more risk, I think this is a great way to do it. Look at the drawdown. Less than the S&P, 28.3 versus 33.9. Standard deviation is a little bit less, 17.2 versus 17.3. Beta is a little bit less at 0.83, but the difference is on an annualized basis, we're outperforming the S&P by 3.2% a year with the same risk. That's hard to do. It's called having your cake and eating it too. So I didn't want to drift too far off the reservation there, but I did want to show you a couple of different ways that you can use CPM, either in a very defensive manner or with, and we've tested this even being more aggressive than that. But I think for now, I think this shows CPM by itself. It lets you have the market historically with a lot less risk, building some of that risk back in to bring those risk levels similar to the S&P. You now have an alpha generating model with very similar risk to the S&P. I'm going to shift my share again and get back to the research center. So give me about 2 seconds for that.
Yeah, and we do have a question while you're doing that.
Sure.
Can you define duration and recovery? What do these refer to?
I'm not sure about duration. That's not something that we look at, but the recovery is, generally speaking, the recovery is how long it takes after a drawdown for you to recover what was lost in the drawdown. That's how I understand it. I can give you more specific answers if that's of interest to you. Go to asburyresearch.com, go to the contact tab. There are so many different ways to slice and dice these markets, and we focus on about 8 of them or 10 of them. Those aren't 2 that we don't focus on, but I'll be happy to give you a better answer if you want to contact me privately. The next thing we're going to do is look at the CEF model. So we're in the research center. We're going to CEF. CEF is Sector ETF Asset Flows. It's an acronym. And what CEF does is we go down to the graphic. I had a model 10 years ago that looked at relative performance. That was the metric. It worked really well for many years. The reason it worked well is because 10 years ago or 8 years ago, whatever it was, sector rotation was a lot slower, a lot more manageable. You would get a sector, outperforming for a quarter or 2. Now, anecdotally, the average is maybe about 6 weeks. That means once you can see the relative outperformance on the chart, that move might be half over. So you're getting into it, and then 3 or 4 weeks later, it's turning the other way. So I decided I either had to come up with a better way to determine sector rotation trends forming faster, or I couldn't do it anymore. There just wasn't enough, there wasn't enough stuff in there for me to capture. So I built a model that measures the velocity of money moving around the 11 sector spiders, which are all represented here, in 3 different time frames: trading, which is a week; tactical, which is a month; and strategic, which is a quarter. The fastest money moving in has the highest score. Excuse me. The fastest money moving out has the lowest score. The best score is 1. The worst score is 11, because there's 11 sector spiders that effectively represent the S&P 500. Think of it like a pizza with 11 slices of various sizes. So right now you can see technology, which is currently 25% of the S&P 500 based on the sector spiders. This is not based on the cash market, but rather the sector spiders. We got a score of 3. That's the best score that you can get. That means it's the best accelerations of assets in trading, tactical, and strategic. 1 + 1 + 1 is 3. Number 2 is financials. Number 3 is consumer discretionary, XLY. The way that we back tested this and the way that I traded for my own account and the way that I recommend others trade it, who are customers of ours, is we back tested this back to 2020, and we equally buy the top 3 sectors. This is rebalanced weekly. On the weekend, I actually rebalanced it early this morning before I was with you today, and we're always in the top 3. So right now, heading into Monday, which is when this becomes executable, we are a third in XLK, a third in financials, and a third in consumer discretionary. So say 33.3 thousand each in a hypothetical $100,000 account, which is how we back tested it. Excuse me. Next Saturday, when this rebalances, let's say hypothetically consumer discretionary, which is number 3 right now, let's say it drops to number 4, and let's say communication services, XLC, it comes into that 3rd position. On Monday, on the opening, I would sell out the XLY, and I would buy XLC. So you're always in that top 3. The logic of this, or the gist of this, is most of the time during sector rotation, there's a lot of small moves where something outperforms by 4%, something underperforms by 4%. There's usually, if you're lucky, there's 3. If you're not so lucky, there's 1 big relative performance move during the past, it's probably going back to past, by memory, 5 to 10 years. So you want to be able to catch that 1 or 2 big sector rotation moves as early as you can and stay with it as long as you can, because oftentimes that makes your year. Poster boy for this is in 2022, when we had the major downtrend. The S&P was down 19.5% or something like that year for 2022. However, in CEF showed that there was money aggressively moving into energy on January 10th of that year, and CEF stayed in there. In other words, it stayed in the top 3 till the latter part of June. And during that period, SPY was going down, XLE was going up. So we outperformed during that period by 40%. CEF outperformed for that year by 8%. It was actually +8, where the S&P was down 19. So it outperformed by 28% that year. That's how this works. It doesn't produce money every quarter. If you go here, I'm not going to do it now, but if you go to models and you scroll down to CEF and click more information about CEF down at the bottom, there's all kinds of performance charts there, and there's tables that show you how CEF has done relative to the market over the past 4 years. It's outperformed by quite a bit. Through June of this year, CEF is trailing SPX by 6.6% year to date. But since June of 2018, CEF is up 20.5% annualized versus 12.5% annualized in the S&P 500. So 8% better annualized if we go back to midway through 2018. Another thing I was going to show you real quick here is the reason I'm showing you these different blends is because a lot of clients say, hey, I get CEF, but how do I use it? Is there a way that I can use it to perform better? And this is what we do for our money management clients, is we do these various blends. The CPM blend that I talked about, 65-35. There's a CEF blend that I'm going to show you here. So I'm going to stop the share currently.
And we do have a question.
And give me 1 second to get this up and running.
Yep.
And then I will take that question. Shoot, go ahead.
Yep. So how are you measuring asset flows in, out, in or out?
We're measuring them by the AUM. We're looking at the AUMs in those 11 sector spiders. How we get there, the algorithm is secret sauce. But we are looking at asset flows via those AUMs in those 11 sector spiders. This is what I wanted to show you. And this is probably the most common blend that we do for our money management clients. If you're a research client, supplies to you too. if, there's just, you just have to make sure you follow the model to a T. So this is year to date for a CEF and CPM blend of 50-50. So you can see right now, SPX is up 16.1, let's call it. And let's say the blend is up 12% for the year. So we're trailing by about 4% with a lower maximum drawdown, a lower standard deviation, and a lower beta. This is how it's done since 6/25 of 2018. The blend again of 50. Again, we're looking at a hypothetical $100,000 account. We got a blend of 50% CEF, 50% CPM. Total return, annualized total return for the S&P during that period, 12.54. For the 50-50 blend, CEF CPM, it's 17.3. So that's 4.5% better with a maximum drawdown of only 18.6% versus 34 for the S&P. These two models help to tamp down the drawdowns when they're used together. Standard deviation is 4% lower, 1410 versus 1810. Good Sharpe ratio of over 1.03 Sharpe ratio versus 0.62 for the S&P, and the beta is 0.72. So again, if you're wondering how to use these models, this 50-50 has worked quite well in our back testing. So the 50-50 blend, again, is what we recommend for many of our money management clients. For more info about any of this, please contact us through the contact tab. I'm going to jump back over here. Give me a sec. I'm going to jump back to the website here. And there we are. So contact tab. Any questions about this, how it works, how to participate, how to execute them yourself, anything that I mentioned here, that's the best way to get our attention. The next thing that we're going to look at is our models monitor. I'm not going to spend a load of time here, but there's a lot of models that we offer clients, and a lot of times things were getting missed. So if you're busy, if you got 5 minutes and a half a cup of coffee, go to the models monitor here. This is updated on the weekend, updated once per week on the weekend. We haven't updated all of our models yet because I am with you now, and actually my son and my grandkids are on vacation, so I'm the Lone Ranger this weekend. But this is where you go. When to be invested, Asbury 6, what it's doing, what the bogey is, positive as of 6/25, the bogey or the asset that we're trading is the S&P 500, down 2%. This is through last week. It's up now by 3.5% or something like that. CPM is also here, risk on as of 5.3. Where to be invested is the CARP model, and we're going to talk about CARP in a little bit. CARP stands for cross asset. The CA in CARP is cross asset. Sector rotation, this is our CEF model. All of our CEF models, again, this is through last weekend. This hasn't been updated yet. Our ETF trading ideas, which we're going to look at. And then our international, our US versus the world. We have no existing ideas right now because, as I told you, all the action is in the US. I'm going to take a pause here and see if there's any questions before we move over to the next segment. Is there anything?
No, we're good to move forward.
Good, I must be doing a good job because there's no questions. So
Absolutely.
So that's good. So CARP, I mentioned CARP is cross asset. There's a lot of confusion about CARP. All CARP is it's a relative performance model that looks at 8 different relative performance relationships, common ones. Stocks or bonds? Should I be in high beta or low volatility? Should I be in large cap or small cap? Should I be in the broad market, which is the S&P, or should I be in blue chips, which is defensive? Should I be in the broad market, or should I be in tech, which is offensive? Growth or value? Should I be in US or developed, or US or emerging? There's 8 of them. And then there are 3 down here for fixed income. in between either government bonds or corporates, high yield bonds or corporates, or short-term versus long-term bonds. So it gives you a sense of where the relative performance is in all of these different areas. The most important part of this report to read is down here. This will explain to you what is meaningful about what you see in the table. So we have through June the 28th, which is Friday of last week, the 6 domestic relative relationships in CARP retained the previous 5 weeks slightly risk-on alignment with 4 offensive and two defensive relative relationships. The 4 offensive: stocks over bonds, broad market over blue chips, tech over broad market, and growth over value. Down here, strategy. Okay, what does that mean? It means that investors are moderately confident that despite the S&P 500's overextended condition, it can still continue rising from current all-time highs. That's the implications. What do you do about it? These 3 are the most significant and stable existing trends via the CARP model. Stocks have been outperforming bonds on a tactical and a strategic basis. Tactical is a month, strategic is a quarter, since 11/3, and stocks outperformed bonds, which is AGG, it's the aggregate bond index, by 21.4%. So if you're watching this model, you would have stayed in stocks over bonds since November, which is when the CPM went to risk on. Growth has been outperforming value since 5/3, since May the 3rd. It's outperformed by 10.1%. Broad market over blue chips. That means stay in the S&P, stay out of the Dow. Broad market, the S&P has outperformed the Dow by 9.2% since January 19th. This shows you where the trends are. So if you're in the market because CPM is risk on and you're asking yourself, what part of the market should I be in rather than the plain vanilla S&P 500? This will give you some ideas as of where to go. Let's look at US versus world, since we're right there. It's right underneath it. Again, that'll be updated later this weekend. We look for geographic regions here rather than disparate outperformance. Not, this one country is outperforming, so we're going to go chase it. But the model is set up in geographic regions. We get South America here with Chile, Brazil, and Peru. We've got the continental US here with Canada and Mexico. We've got Western Europe here from Switzerland all the way down to the Eurozone, all of these. We have Asia Pacific area here, Malaysia, Japan, Hong Kong, and so on. We have New Zealand and Australia, which Oceania is what they call those two, and some other islands. And finally, emerging markets down here at the bottom. Note that Taiwan and India are the only 2 that are outperforming. India is not trending. We're not paying attention to that. The reason Taiwan is because it's being driven by the island's position as a key player in the AI revolution. And if you click these hyperlinks, this will take you to a story. This one happens to be from CNN, but it will take you to a story where you can kind of see a little backup as to what's going on. Why is this happening? Why is Taiwan outperforming? So let's get rid of that and go back here to sector our ETF ideas, which back to the research center down here. ETF trade ideas. The thinner the market is, the more narrow the market is, like it is now, the more difficult it is to find quantitatively the criteria that we need to put these ideas out. We need a positive price trend. What does that mean? It means that it has to be in a relative uptrend relative to its 200-day moving average. Number 2, relative outperformance versus the benchmark S&P. It needs to be outperforming the S&P. In my world, telling someone to buy gold and over the next 3 months the S&P's up 11 and gold's up 4, I'm not taking any victory laps. They were better off staying in the plain vanilla S&P 500. I need to see relative outperformance versus the S&P 500. Right now, the only stuff that's outperforming is stuff like technology and semiconductors and software and stuff of that nature. I need to see expanding assets, which is AUM, and that particular ETF that we're looking at. I need to see monthly expansion in their AUM, assets under management. And then I need to subjectively look to see if there's any risk reward in that idea. I'm not going to buy something that's up against a 2-year high. That's what amateurs do. I want to buy it when it gets on the other side of that high, and now I can use that old high as a support level. So this is what the table looks like. And you can see we've only got a few here. We've got telecom, part of tech. We're actually short home builders. I don't put out short positions very often, but in a market like this, I want to try to put out whatever I can for trading ideas. And we're short. That's why everything is red here. We're long growth individually. We've been overweight growth since whenever it was January, according to the CART model, which you just looked at. And then we're also long XNTK, which is NYSE Technology ETF. These are our previous, there's probably about 15 trades in here. These metrics, I just want to show you because it's important to understand. This is not investing. I'm not trying to pick, the next Apple here. These are trades. A lot of our customers are interested in making shorter term trades or using our entries in a short term trade to take a longer term position. Our entries are very good. So for the period 3/17 through 4/6 of last year to 4/16 of this year, which is about 13 months, we gave out 46 trade ideas. Average profit per trade, 4%. Annualized return. We have maximum drawdown here of only 5.1%. Sharp ratio, very good, 3.7. These are the ones I want to show you. Percentage of winning trades during that 13-month period, 74%. Honestly, that's historically high for us. If we can get anywhere in the 2/3 area, 65%, 66%, have 2/3 of them actually become profitable, I'm thrilled with that because our average winning trade is 7.4% and our average losing trade is down 5.8%. So we're about 1.5% better on our average winners than our average losers. And we've had 16 winners and 8 losers. So this is what to expect. If you're looking for us to find you the next Apple here, that's not what this is for. This is for finding trades with major trends, outperforming the S&P, assets expanding, and good risk reward. The average length of a trend in trading days for this particular model, we're in the winners for 16 days, we're in the losers for 8. So those are the numbers to help you understand how that actually works. So the next thing I want to do is we're about 45 minutes in, is we're going to go back to the research center. I just put out our latest keys to this week. I think to give you a quick overview of what we think is important at Asbury is to go through there. So we're going back to the research center, and all of our individual reports are down here in chronological order. Keys came out on Friday, mid-morning or so. That's going to be first, Friday, July 5th. Scrolling down, here was our overweight idea also on Friday, long overweight in XNTK. On July 3rd, we made an outright buy idea in SPY-G, which is the S&P 500 growth ETF. Holiday schedule, obviously here. Here's our short and home builders. Here's our Beyond the SEAF model. By the way, while I'm here, if you're a SEAF fan and you want more detail on that, this comes out midday-ish every Monday. If you scroll down to our Beyond the SEAF model video, my son Jack, who's my partner, and he'll be the legacy on Asbury Research one day, he goes through a lot more detail on the asset flows that are moving around those sector spiders. There's we have a heat map that we look at to kind of show the hotspots where the money's kind of coming in and where it's going out. It's about 10 minutes long, actually 5 minutes long, 5.38 here. If you like C, if you want to understand it better, I strongly recommend that you check this model out. Now let's get over to keys. So keys to this week: Microsoft, Apple, and the Dow indicate the potential for an additional 2% to 6% higher within the current advance. Here's our conclusion. I'm not going to read that because that's something you can do. But what we do is I probably go through 150 charts or so, and I look for the 10 that are the most meaningful and most germane to what the market's doing right now. And I put them into this little table because it shows me, I kept this internal for years, it shows me where the action is right now. And you can see very little in the negative, a whole lot in the positive. Tactical, again, is 21 business days for us. That's how we move in and out of the strategic trend down here, which is several months long. Strategic is 63 days. That's our time period, 63 days or more. So you can see most of the activity, most of the emphasis on this table is in tactical positive. Let's look at them individually. Here's the S&P 500. We always take chart one, show you where the support levels are, because you need to know where the hot spots are on this chart. So right now, we have a little minor support at 54.48 in the S&P, but primary tactical support is at 53.42 to 53.10. That's the 50-day moving average here in blue, and that's this high from March the 28th. That's about, if my memory's correct, about 4% underneath the market. Major support, it's about 13% below the market at 48.87, which is the orange 200-day moving average, and 48.19, which is the benchmark high from Jan of 2022. There's about 9% of real estate in between the short-term trend and the long-term trend. So what does that mean? It means when we get the inevitable corrective move lower and we break through here, that we could hypothetically go down another 8 or 9% and still be in a major uptrend, because the major support is here. Why does that matter? If CPM tells us risk off, first A6 is going to start to turn red and tell us the internals are starting to fall apart. CPM will tell us when it's actionable. And if we're through 53.10 at this point, we can say, hey, the next place that we're likely to stop is from this 49.54 to 48.19 area. Once we get down there, we've avoided 6 or 7% of drawdown. That's what the CPM is for. If we can reallocate those funds back in here somewhere after CPM gives us the all clear to be risk on again, that's where you'll make your money for the year. Avoiding most of the correction and reallocating that money lower. It's the same thing as hitting a home run to me. That's the most exciting and fun and meaningful thing to do, is if you can avoid the drawdown, avoid 6, 7, 8% of a drawdown, reallocate those funds lower, and get that boost that the CPM will show you when the market is getting better and we're getting some new buying starting to come in. Next, Microsoft. Bullish chart pattern in Microsoft that was initiated on June the 11th. I've been talking about this, probably some of you, ad nauseum. It's super important. Microsoft is number one in market cap. It targets a move to 473, which down here on June the 11th, that was 10 or 12% higher. Now it's only 2% higher. Why does it matter so much? Because Microsoft is such an enormous part of the market, and it's linear correlation according to, if any of you are statisticians, we use a Pearson coefficient for this. It's just a simple linear correlation. for the past 40 years has been mostly in the 0.8 or 0.9 area versus the S&P 500. So as goes Microsoft, typically, historically, goes the S&P. So if you're saying, John, how much higher can this go? Well, according to Microsoft, this can go about 2% higher. Here's Apple. Apple is number 2 in market cap. It broke out of a different pattern, 11 months of investor indecision here. Also on June the 11th, there were some important AI and Apple related announcements in the news on June the 11th, June the 12th. Check it out in Google and you'll see them. That was the launching pad for this move. Targets to move to 230. From 178.51, the breakout, we've already captured most of this target. 230 is also about 2% higher than where the market is right now. So again, according to the 2 biggest stocks, that Apple also has the same kind of linear correlation with the S&P 500. How much higher can it go? Well, it looks like it could go 2% higher or more. This doesn't mean that someone's going to ring a bell at 230 and it's going to go down to 170. Those are the targets that we discovered on June the 11th. They're getting close to being met. The Dow weekly. This is a weekly chart going back to late 2019. The reason that I love this chart is because the Dow is defensive. It's the opposite of what Microsoft and Apple are. This chart pattern, which was initiated in January of 2021, after we rose off of the COVID highs here in March of 2020, we drifted sideways for a couple of years. And then we broke out on DC1. You can see the parameters of the pattern, kind of a triangular pattern, while holding this major support level at 29,569, excuse me, from the February 2020 high. This targets 41,500. That's about 6% higher than where we are right now. So how high can we go from here, John? Well, without a correction, another 2% higher. With the correction, as long as we stay up above roughly 37,000 in the Dow, we got another 6% to go on the upside before we hit our target. So somewhere between 2 and 6% is feasible. Here's our Asbury 6. Everything's green. These numbers in here are the dates that each of these 6 constituent metrics turned green or positive. You could see a lot of these turned at the end of June, June 28, June 25, June 25, or on Wednesday, trading volume and market breadth. So this is a pretty recent move back to a strong green position. What does that mean? It means internally, right now, the market is, if the market is your 6-cylinder Chevy in your driveway, it's clicking on all cylinders. Can it change quickly? Sure, that's what this is for. But right now, despite the market's overextended bias, clicking on all cylinders. Next question is, what's the participation looking like? So here we've got the AUM in the QQQ. Invesco QQQ is the ETF that tracks the NASDAQ 100, which is big cap tech, which is where Microsoft and NVIDIA and Apple are, and Amazon is. Note that it's expanding. This AUM is expanding. It started expanding on May the 3rd, and NDX is up 14% on that expansion. Note that between April 10 and May 2, it was kind of down in the dumps. I wouldn't call it a downtrend, but it's taken a rest. We've got the highest, the most expansive these assets have been since the beginning of the year. These might even be all-time highs. So the money is charging in there. These AUMs, like open interest is in futures, they're trend fuel. It shows overnight conviction that the next morning, I feel like the market's going to be higher. Volume shows day-to-day urgency to trade. That could be all over the map. These guys are making bets and holding them overnight, which is why they show up in the AUM. AUM is NAV multiplied by shares outstanding. This is bullish. Investor sentiment is according to the investors' intelligence data, of which Asbury Research is one of the inputs, which is great because I have access to all their data and it's very helpful to me from a sentiment basis. They're as least bearish. Oh, they're only 16 to 14% bearish right now as of April the 12th. Why do we care? Because these red verticals show you previous times when it was at this extreme bearish level. This is not a timing tool. Asbury 6 is a timing tool. CPM is a timing tool. This tells you what the environment is. What's the word I'm looking for? It's showing you the environment. That's the best I can come up with. The environment is companies like ours, which are part of this survey, which are independent research providers for the most part. They're really bullish. They're not very bearish, is another way to say that. Why does that matter? Because at some point, that leads into important tops. That doesn't tell us to sell today, but it does tell us the market is a little bit too over its skis sentiment-wise. And when it gets that way, you often run into some pretty serious declines, like the COVID decline here, and like the 2022 major downtrend here. Next, standard deviation. Right now, the percentage of NYSE stocks trading 2 standard deviations above their 40-day moving average is relatively low. Why? Because most of that strength is coming from Microsoft and Amazon and NVIDIA and Google. So what happens typically when the standard deviation looks like this is we get market bottoms. April 18th, market bottom. Jan 17th, market bottom, and so on. So counterintuitively, standard deviation looks like that 2% higher. This is a condition for us to hit that 2% higher in Microsoft and Apple, and maybe keep going from there, maybe even hit the Dow going 6% higher. We don't know. It hasn't happened yet. I used to do a lot of forecasting 20 years ago because that was, if you had a nice suit and you had a crazy forecast, they'd put you on CNBC. I do a lot less of that now because that's showbiz and I'm in the investment business. We're following the data. That's all that matters. Doesn't matter what John thinks. Doesn't matter what I think is going to win the election or what's going to happen to interest rates. That's water cooler talk. This is data. Data matters more than water cooler talk. And here's just size and style. Large cap, outperforming, breaking out of its non-trending zone on May the 24th. We caught all of this. We're still overweight large cap. Medium and small cap are underperforming the S&P on a quarterly basis. And this is growth. Growth broke out of a very similar pattern versus value on May the 23rd. It also corresponded with a nice move higher in SPY. So that is the keys to this week. The last part of this is I'm going to go to some live charts, which I want to hear your feedback. I want to make this, if possible, the best part of your Saturday. I really want this to be informative for you. So let me know if you like what we're doing here. How can we change this to make this better? I'm going to do a different screen share right now. So give me just a second to queue up my live charts. And I'll take some questions while I'm
Yeah, we have one question. Are you showing Asbury 6 at strategic decision point?
I don't know. I have to go back there and see what, can you tell me what you're referring to?
Mike, let us know in chat exactly what you're referring to. And
So
then
let's go back there real quick. Here we go. Yeah, let's go back to what you're, there we go. Okay, I should be screen sharing again, and I think I know what you're referring to. Yeah, tactical decision point. Yes, good catch. That refers to 7.3 and 7.3. we went from 4 to 6. As recently as 628, we went to 4 and 2. So within the past 5, 6, 7 days, the A6 went from kind of being equally balanced to swinging back over to all 6 green. That's what the tactical decision point means. It shifted from a kind of a neutral 3 and 3-ish ranking for a lot of June to all green again. So yes, and that's what that refers to. Hopefully that clarified that. So let's go over here. I'm going to do another screen share, and we're going to move to teach-in charts. So these are not in any particular order, but these are charts that I think are particularly interesting. You should be able to see right now a chart of Apple. Audrey, see that?
Yes, we do.
Thank you. So what we're showing here, and you've already seen this chart, but this is the important part of Apple. Apple started out underneath here. This is a relative performance of Apple versus the S&P 500. This gold line or yellow is the 63-day moving average. So Apple had been underperforming on a 63-day basis since, let me move a few things around so I can see this. Okay, that's better. All these windows show up in Zoom, and sometimes there's so many of them you can't see what you're trying to see. So from Jan 2, Jan 3, all the way to 4/24, April 24th, Apple actually underperformed the S&P by 15%. Since here, May the 3rd, it's outperformed by 16% and change. That's a big deal. So we have our 230 target in Apple, which is just under the market by $4 a share. This is the key support level at 198.23. This outperformance is, in my view, relative outperformance is at least as important as this big price chart on top. I know this is how we get paid, but relative performance is really important. This is Amazon. It's one of the top 4. Note that Amazon, let's get a little closer here. Amazon had been bumping up against its highs that it made here in July of 21 and in November of 21. It tested it again here in April, tested it again here and failed in May. This little chart pattern shows investor indecision. We broke out of it on May the 27th, or I'm sorry, June the 27th. The target's to move to 213. 213 is about 6% higher than where we are right now. Amazon, although not as tight as Apple and Microsoft, also tends to move with or lead the S&P 500. So this is another, and notice after kind of underperforming here since May, it's starting to outperform now. So we could get another 6% move higher in Amazon. Watch 188.65. That's the support level that you want to hold if this is going to go back, if it's going to go to 213 and hit our target higher. Again, based on those old highs that we made here back in 2021. So this is an important chart to watch. If we slide through 188.65 and go back through the bottom of this pattern, that's a big bearish reversal. That's bad news. So you can use this as kind of a bellwether. This is the NASDAQ Composite Index. You can see that it was a relative performer versus the S&P really since the beginning of the year, but kicked into relative outperformance in the beginning of May. Since then, it's outperformed the S&P by 5%. It's important. We're making all-time highs here in Compact. We're outperforming the S&P. That's normal bull market activity when your technology parts of the market, both NASDAQs are outperforming SPY. That's a healthy market. The flip side of that is Dow Industrials. People move into the Dow when the market is weak or people don't have confidence in the economy going forward. You can see the Dow has been underperforming SPY on a quarterly basis, that's what the yellow line is here in the lower panel, it's underperformed by 9%. Normal bull market behavior. People moving out of the defensive, the burrows, I call them, the sure-footed burrows, and onto the racehorses, which are the NASDAQ. So all of this is bull market behavior. This is the SOX index, semiconductors, starting to test all-time relative performance highs here while it's testing new highs here. Semiconductors and in the NASDAQs typically lead in a healthy bull market. They're starting to outperform again. Let's look at NVIDIA. NVIDIA is probably the number one stock to give people heart palpitations these days. So here's NVIDIA. This is really an interesting chart. Here's NVIDIA from its peak in August, drifting sideways all the way until that conference in Vegas that I talked about on the Jan 8th and 9th. Here's Jan 8, here's Jan 9. Big breakout. NVIDIA has risen by as much as 163% since then, and it's outperformed the S&P 500 by 122% since then. Note that the breakout on Jan 8, which is right where I'm pointing to right here, also coincided with this sideways relative performance versus the S&P shifting into overdrive. What do we watch here? Watch this support down here. This is very tactical. I'm not saying this would be a major top, but if you're looking for a little wiggle down and you want to know how to find it in NVIDIA, this little support level here, let's call this $118 a share. If we break through $118 a share, we have a little chart pattern on here. It's a bearish head and shoulders pattern. Doesn't mean the world's on fire, but it does mean that NVIDIA might be starting to take a rest. Where could it go? Well, the 50-day is at 110, and this big support level that we have since March 8th of this year is at, let me give you exactly where it's at. It's at 97.40. So right in here, let's use this box for a target zone. If you're saying, God, I missed NVIDIA, I'd love to buy a pullback. This is where your risk reward is right now. And between basically $108 and $100 a share. If we get down there, contact us. We can help you individually, but we'll be looking at that as a possible re-entry point. We're not going to blindly buy it as soon as it gets into the box, but we're going to start watching market internals to see if it's supportive of a new place to buy the break in NVIDIA. Let's see what else we have here. We're getting close to the end. Here's Ring. Ring is the iShares Global Gold Miners. So I told you we bought it here earlier in the year. We sold it here. Why? Because it bumped up against this major resistance level, which is this high that we made back on 5.9 or 5.4 of 23 at $28 a share, and this monstrosity of a trend line that goes all the way back here to 810. So I'm in these trades in the ETF ideas. I'm in the trades to make money and not to get married to a position. So I bought here, sold here. I don't know what we made, 5-6%. And then we bought the breakout right here, and we sold it over here for no loss, no gain. Why? Because it didn't hold the breakout. Well, look what it's doing. It's getting back up above the resistance level. More importantly, it's starting to outperform the S&P 500 on a quarterly basis. It's edging above that yellow 63-day relative performance line versus SPY. Why do I care so much about that? Because telling somebody to buy gold again, and gold goes up 4% while the S&P goes up 10%, I don't feel I'm doing my job. I need to tell you where the money's going and to go there and not to find some trade that went up and it underperformed. Once this starts outperforming for a while and I get more internal evidence that this is a breakout, we will buy this again. SLVP, which is silver miners, also knocking on the door of this big area. We bought silver miners here earlier in the year on this white arrow. We sold it here, did well. I think we made 12 or 13%. Well, why'd you sell it, John? Because it held the resistance. And for me to have a 13 or 14 or 15% open trade profit and give it all back is just dumb trading. I would rather ring the cash register. Doesn't cost any money to trade anymore. When I started in the business, it was $50. All of the money was in the brokerage side. Everybody wanted to be a broker. Now that part of it's free. So I have the ability to sit here, take this 12% to the bank, and patiently wait for this to start to turn higher. It's not there yet, but it's getting there. Finally, interest rates, the big levels right now, the yield of the 10-year, this is TNX, which is the index for the 10-year note. 470 is the upper boundary. We were there right here on April 25th. Fortunately, I bought a whole lot of, even though I'm an equities guy, the 8 to 13 week T-bills were 5.4, 5.5% here. I bought a bunch of those here. Why? Because it was a resistance level and it was a value level to take advantage of that yield. Now you can see those yields have dropped. This 485 to 432 level is basically no man's land. Underneath, 404 is the bottom part of this window. So basically 4% and 470, we could do a lot of banging around in there, and it's really not going to make a material difference in the trajectory of long-term interest rates. So with that, I'm going to do one more fast share very quickly here and go back to asburyresearch.com. If you're a user, if you're a subscriber, I'll take any questions that you have right now. We're getting at an hour and 15. If you're here on a one-time guest kind of pass, so to speak, to see what we do, and you have questions, you can contact me directly through the contact tab up here, and we'll get back to you. So Audrey, any questions?
Yeah, we just have one question. So before you went to the live charts, the question is, do these charts back up the CARP model? So this question came in before the live charts.
They do, because CARP, we were looking at, let's go back to live charts real quick. Yeah, these charts and CARP are really one and the same. So CARP, we looked at stocks over bonds, right? So stocks is TLT. TLT is the iShares 20 plus year treasury bond fund. It's the price of the long bond. And when we want to look at the relative performance versus ag, and ag is the aggregate bond index. Which is right here. So here, stocks over, this is, or stocks rather, this is SPY versus ag. I'm sorry, this is SPY versus ag. Here, graphically, is where CARP said buy stocks over bonds. Look at all this relative outperformance. Look how it stayed above that yellow or gold 63-day moving average. CARP also said growth over value. SPY G is growth. SPY V, like Victor, is value. And the green arrow is when it showed up as actionable in CARP, right there. Now, this isn't an enormous move because, what is it? Well, it's 15%. It is enormous. It's not so enormous versus SPY. Versus SPY, I think it's 3 or 4%. But this is CARP right here. The S&P 500 over the Dow. That's SPY versus DIA. DIA are the diamonds, which is the ETF that tracks the Dow. Correct. Here's DIA. This is when CARP said, don't buy the Dow, buy SPY, SPY over the Dow. SPY outperformed DIA by 10.6%. And if you looked at tech, let's look at Qs versus SPY. Right here in CARP is when CARP said buy Qs over SPY on a relative basis, and it's outperformed by 4.7%. So yes, this CARP is a model that is done quantitatively, but it's taken right off these relationships. Are there any other questions?
No, there are not.
Okay, so with that, I'm gonna say look for a weekly wrap up on Sunday. Our weekend piece will be out on Sunday. Again, we are managing money. If you're interested in that, having us trade our models for you, contact tab, send us a note. Let us also know what you'd like to see in future teach-ins. We will see you in 1 month, tentatively Saturday, August 3rd. So put that on your calendar with our next live teach-in. We'll officially announce the date and time approximately 10 days before the event. There will be a video. There's a video that is being created right now. Once that video has been rendered, we will make it available to you. It should be this weekend. It might even be today. Go enjoy your weekend. Hope it's nice out by you, and have a wonderful weekend. We appreciate your business. We're always available to answer your questions, and we'll see you with another one of these in about a month.